guys. Great. All right. Welcome, everybody, to another LFI scouting report. We've got a couple groups with us today. Wanted to just kind of reemphasize the scouting report format for some people. We've only done, I think this is maybe the fifth one of these we've done. So for those that haven't participated, this whole industry really is based on relationship building and getting to know people. And what we try to provide opportunity for with Left Field is operators to come in and meet the community and the community to meet new operators. And this was our model to set up kind of like a speed dating episode to allow a couple operators come in, 2 or 3 for an hour period of time and give their elevator speech just so they can introduce themselves to the group. And if people are interested, please reach out to these operators and start that conversation, build that relationship. That's what this is about, is trying to introduce people. So that's the model. We'll give each team here, we've got 2 groups on, 20 minutes. We'll strive for about 15 minutes of content and then offer up some Q&A. And then if there's time at the end, we'll open it up to Q&A for anybody if people have questions. But if you do have questions as we go through, please drop them in the Q&A section of Zoom, and we'll ask those to the group to see what they've got. But with that, I'm going to start things off with the DXE team and let you guys present. Again, thank you for coming on, and we look forward to hearing about your group here.
Perfect. Thank you. And you see my screen?
Yep, we're good.
All right, Donato, I'll let you lead the way and jump in from there.
Sure, of course. So we are DXE Properties. You're on this webinar with both Josh and Donato, founders of the company. A little bit background on myself. I'm the co-founder of DXE Properties. I really grew up in the New York City construction industry, I'll call it. My first job out of college was building the new Yankee Stadium in the Bronx, New York. I subsequently went back and got a master's degree in real estate finance and development from NYU and went to work for some of the city's largest developers there. I developed many billions of dollars worth of real estate, including one of Manhattan's tallest residential towers at 1,400 feet, as well as Google's flagship new building down on the West Side Highway.
And my name's Josh Eidengon. I'm the other co-founder of DXE. My background is nice and different. I bought my first multifamily deal when I was 25, living at home, a 20-unit distressed property in Cincinnati. After doing that, I went to work as an analyst for an investment firm, ultimately led an acquisitions team there where we bought a few $100 million worth of multifamily real estate in the Southeast. At that point, Donato and I came together, started DXE, and we really had an opportunity, I think, to leverage a lot of those contacts from both a brokerage perspective, ownership perspective, property management perspective, sort of seeing me and us executing at a larger scale, higher level. And it allowed us to really kickstart DXE to buy some, I think, pretty compelling deals over the last I don't know, 5, 6, 7 years. So we bring together what are 2 very different backgrounds. One, mine, which is a little bit more entrepreneurial, Donato's, which is much more institutional. And we use that really from a day-to-day perspective. So from an investor relations perspective, from an asset management perspective, from a construction management development perspective, we really try to take an institutional, call it, lens. And then from an acquisitions perspective, I think we get a little bit more entrepreneurial. We're New York based, though most of what we own is in the Southeast. We'll speak a little bit more to that. But we are a group and a firm that really just tries to do 2 to 3 very compelling deals every year. We'll talk to what those deals look like and what we are actively focused on over the next 12 and 24 months. But we are actively offering on deals, actively working with owners directly, with brokers directly, property managers directly to uncover what we think are, call it, better than market deals that are conservatively underwritten in any environment. we take a pretty data driven approach, both at a metro level and the MSA that we're investing in, but frankly, even more than that, in a sub-market level and property level. To date, we've acquired over $150 million worth of real estate. We also have over $150 million worth of real estate under development. We've realized returns of over 35% IRR as an average across those deals. We have over 200 active investors, over 1,000 apartments owned, and a track record of over 8 years and projects completed across 7 states. I know you'll see this because we did include the firm profile here, but this is our track record. And you could see how we came up with that average, obviously, across the sold deals. But I think the deal that I would highlight would probably be our most recent sale, which would be the Retreat Savannah. We bought this deal in October of 21, which is a period of time, call it from end of 21 into the beginning of 22, where, you know, I'd be pretty nervous if I bought a deal at that point, not knowing anything else. We sold that deal last month. It was a deal that we bought with floating rate debt. We could have refinanced, but ultimately felt that it was a good opportunity to, rather than lock ourselves in with a nice and high rate on an older asset, we could, you know, check the box and call it a win. And we hit a 26 on that deal in under 2 years. So we were happy about that. But more than anything, I think it speaks to just conservative nature of underwriting, that we were able to buy a deal, I think, you know, more towards the peak than anything else. And we stress tested that deal, and we were hit with a confluence of call it headwinds from rising insurance environment, particularly in coastal markets, a rate environment that completely changed and has put a lot of owners underwater and in severe strain and stress. And we're not in that position, and everything else that we own has fixed debt and, you know, is cash flowing comfortably. So, you know, I almost hate to say that because I feel we're talking that positively about ourselves, but I think it's a good example, and it speaks to just our nature of underwriting. You know, I've said it before, I'm a firm believer that you could buy good multifamily deals in any environment. But we certainly believe now is like now and over the next 12 plus months, there'll be an outsized opportunity to really buy very compelling deals and attractive bases. So our business strategy, we're always chasing deals with a story. My acquisitions background won't let us not. In both existing and new development sites, though right now we're really just focused on existing assets. We are built to do heavy lift deals between Donato's construction background, my past background. We like deals that have some hair on it, where we could invest a whole bunch of money into it and really, you know, really transform that asset. I will say right now, those deals are difficult to do between just debt factors, equity needs, and the fact that so many of those deals have already been touched. That said, if you put a deal in front of us that's been owned by the same owner for 30 plus years and is in a great location, we're going to give it a very, very hard look. One thing that I think distinguishes us among other groups that are in this space is that when we make improvements to an asset, we really want to do a true renovation. So if we're touching a unit, we're not going to put like quote unquote lipstick on the pig. You know, we want to make a lasting improvement that's going to distinguish us among the same or similar product types within that submarket. It's just, call it a core belief of DXE and the way that we operate. Most of our
Just to add on that, we really do believe, and we've seen it work, that, you know, elevating the tenant experience really does work from an investor dollar in our pockets point of view. So when we're doing a renovation in a bathroom, we're actually we're changing the plumbing valves, we're changing all the braided lines, we're redoing the traps in a bunch of cases, and you know, no one sees that, but the tenant sees it on the back end when they don't have to call us for leaks, and they renew the next year because, you know, their friends down the street in a renovated apartment that is always leaking. So that's what we mean by that.
Yep. Yeah. We are in, I'll say, middle market, which gets used in a variety of ways, but our deal size is in the call it $10 to $40 million range. We like that. We certainly have competitors in that deal size, but I think it's a size that allows us to get a little bit more yield when you compare to the smaller size, where you could have owner operators that may be able to minimize salary costs or property management costs. And then on the larger end, you just have institutional capital that has a need to make less money potentially on their investment. So they are willing to pay more. So we'd like that, that call it sweet spot size. And then most of our recent acquisitions, the last two have been 2007, then we had 2020, and then we have a deal under LOI that was built in 2019. These have been newer vintage deals. It's something we believe in. We think now when you take into account risk-adjusted returns and Donato will speak to it, but there's going to be some strain on newer products and older products alike, and we see this the bubble of newer deals where you can do a light value add at an attractive basis as being compelling. Typically a 5 to 7 year hold, though we will exit earlier opportunistically. And our target markets are in the Southeast, North Carolina, South Carolina, Georgia, Alabama, parts of Florida. More specifically, it's going to be the largest 2 or 3 cities within those states, excluding Florida, where it's really just northern Florida where we're interested. And that's just, we want to see some diversity of employment more than anything else. And I'm speeding up for the sake of fitting it in our time slot here, Chad.
That is Josh's sped up version, if you could believe that.
We appreciate it. We appreciate it.
Thank you, Josh. Donato from DXE Properties. So, we went a bunch through our background, where we're investing, and the real question that everyone's asking us now is, where do we see opportunity right now in this heightened interest rate environment? Rents aren't increasing as fast as they were. Insurance rates have skyrocketed. It's harder to evict people. There's a whole bunch of confluence and factors that are just working against the market. So where are we seeing opportunity? Well, one thing that has really reared its ugly head is the cost of home ownership. So in the last quarter, it went up 8.7% from a year before. That's $763 more when you look at the cost of home ownership versus the cost of renting an apartment. So as you could see a couple of years ago, that gap was pretty close. So if you had the money as a down payment, it was really easy to go buy a home and start the American dream. But as the economy is taking a turn and all these factors are working against the middle class person, that gap keeps growing and growing and growing, which is going to force people to continue to be renters into the future and hold up demand for the rental market. Also, over the next 12 months, we're going to see a lot of supply come on the market. So we went through a record building boom post-COVID. And in fact, over 650,000 units are expected to come online next year. So what's that going to do? As much as the renter is going to have to stay a renter because that jump to home ownership is growing, there's going to be pressure from the other side where there's just going to be so much supply coming into the market, which is going to hold vacancy a little bit higher and probably hold rates down a little bit lower. So all that being said, where are we going to find opportunity in this market? Finally, there's a record number of loan maturities that are going to happen between 2024 and 25. So that's where we see the opportunity. Although there's these forces working against us, we're going to see opportunity because there's so many loans maturing, and a lot of these people that really bought into the run up in multifamily, a lot of them bought at very low fixed rate debt or even floating rate debt, and now they're in trouble because their interest rates are so high. In a lot of cases, it just doesn't make sense for these groups to refi, and it'll make more sense for them to sell at a discount, maybe even a discount, or in a lot of cases, a discount to where they purchased. That allows a new group to come in with stabilized debt at a yield that actually makes sense and starts to cash flow. As the economy gets better, obviously, that cash flow is going to increase while our debt payments are going to stay the same because we're going after everything with fixed rate debt. So this is really where we see, we see some bumps in the road for sure in the multifamily call it arena, but we really do believe that long-term demand is there, and we want to take advantage of that through going after projects with these loan maturities. And that specifically, we want to look at new build products. So products with less maintenance, they're going to have lower insurance costs. And they're developers that just want to get onto the next project. So they are much more willing to sell at a par or much less profit than someone that is holding through a fund term. And that is really where, we're looking to buy right now. We've been aggressively scanning all the markets that we're in to find these sorts of deals that we could hold for the next 5, 7/10 years.
And I know this question, but I'll jump in real quick, and then Donato, I'll let you answer that question. So we were connected to LFI actually from an existing investor of ours who's a part of your group. So we thought it was an exciting opportunity. We certainly welcome the opportunity to connect with anyone that's listening in. So you could do so by getting on our calendars. We're happy to do a one-on-one Zoom with you. For those of you that are local to New York, we're happy to meet up for a coffee. Otherwise, please do join our newsletter where we just share a lot of interesting, I think, market information month to month. And if and when we do have new deals, they're shared via our newsletter, call it platform and communication tool.
Great. Thank you, guys. Thank you for staying on time too. Appreciate that. But really appreciate the information. This is exactly what this is about. Just to let's get a good understanding of what you guys are about and see if we can start the relationships. There are a couple questions. Josh, I'm more than happy to read them out, or you can read them out and you guys can answer them however you want to go about that.
Sure. Donato, you want to take the first one?
Yeah. So the first question was, can you explain your contractor selection process? Are you able to use the same contractors on your projects, i.e. establish a rinse and repeat process? So we really do try to do that, find qualified contractors and then rinse and repeat. Unfortunately, in the run-up in multifamily, there was a bunch of, call it fly-by-night contractors that got way too big, way too quickly, who were performing and have since gone under. So we've seen that. I don't know. I couldn't tell you how many contractors at a GC level we've seen gone under. At a subcontractor level, we've seen gone under, and then just a supplier level that we've seen gone under already at this point in the market. So it's not a one-size-fits-all question answer, but we have a pretty good vetting process. A lot of it has to do with walking on site. I've got about 20 years now of construction experience. So as Josh knows, my favorite thing to do is walk on site, act like I've never done a renovation, and have the contractor tell me all the things that he's going to do, figure out, where he's right, where he's wrong, and then at the end, just quote unquote, hit him over the head with a hammer and be like, oh yeah, now we're going to do it this way, and this is how this is going to happen, and just see how they respond to that type of thing.
Great.
And then the next question, do you accept 1031 investors? Situationally. So it depends. I think if you do have a 1031, we'd be happy to have a conversation, but it needs to fit upcoming deal structure, your timeline, meet everyone's expectations. So I can't give a black and white answer, but to the extent there's interest in connecting, we'd be happy to talk through it. We've done 2 or 3 to date that was a tick. With 1031 investors involved.
Great. Thank you for that. I don't see any other questions in there, but please, if you have other questions for the DXE group, drop them in the Q&A. I think since it's calmed down, we'll jump over and talk to the GSP REI guys and let them go through their presentation, and then we'll circle back to more questions at the end.
Perfect. Thank you.
All right. Thanks, Josh. Thanks, Donato. And now we will have the GSP REI guys come on and welcome. Thank you as well for attending, and we'll turn it over to you guys to present.
Awesome. Thanks, Chad, for having us. It's a pleasure to be here and to connect with the group. Let me just get this PowerPoint going. Okay. So, like I said, thank you, everybody, for being here. Chad, thanks for having us. Let's get right into it. I want to respect the time and make sure there's time for questions. So a little bit about GSP REI by the numbers as of October 2023. So our first fund launched in November of 2019. And since then, we've had 4 funds, 2 are closed, 2 are actively raising capital. And we've paid our fixed promise preferred returns since inception in all of our funds. So there's 2 parts of our business. We invest in single family rentals and we invest in first mortgages. The funds that are open to accredited investors invest primarily in single family rentals. So it's going to be hard assets, real property. And then our first mortgage fund is an exclusive partnership with an institutional partner. And one of the reasons we really like first mortgages is it leads to a single family asset, and the exit could be a disposition or it could fit as a rental in our rental portfolio. So combined assets under management between the first mortgages and the rental portfolio is a little over $57 million. That includes roughly 100 rentals and a little bit over 320 first mortgages. The capital raise. So we have raised over $10 million from accredited investors for our funds. And we've had our institutional partner on the note side commit over 150 million. The portfolio is it's spread throughout 40 different countries or 40 different states, sorry. And the states that we focus on primarily for the rental portfolio is going to be Maryland, Pennsylvania, and New Jersey. So the Mid-Atlantic, and we're based out of Philadelphia. And I'll get into that a little deeper in just a minute. So things that I want to cover, it's going to be our strategy, the team behind it, our model, the fund opportunities, and then the impact that we create in the communities that we invest in. And then hopefully we'll have time for some Q&A. So, like I said, the asset class that we focus on is scattered site, single family, affordable rental housing. Usually that's going to be a 2 to 4 bedroom, single family home. And that is an asset class that I believe has the most demand out of any real estate asset class right now. So what we typically do is we like to buy fully distressed properties, value add, and occasionally land. And we'll buy those either individually or in portfolios. One of the reasons we like distressed properties is we can go in and we could do all the construction, in some cases bringing it down to the bricks and, handing over new construction to our tenants. So it's going to create less work for us to do from a maintenance side down the line. It's going to be a higher quality product that we hand over to our tenants. And then we do all of our construction and property management in-house. So we're able to control the timeframes and the budget. So that's one of the other reasons we really like the distressed properties compared to value add. But we do a combination of both because the value add sometimes could lead to cash flow quicker compared to distressed properties. But we can do a distressed property pretty quickly with our in-house construction. The markets that we target, being that we're based in Philadelphia, we really like Philadelphia, we like Baltimore, and there's certain parts of South Jersey. These are markets where there's a massive need for single family affordable housing. There's a lot of opportunity. One of the things that I like about our model is it's simple in what we do, but it's very effective and it's repeatable and very scalable. And one of the things, like similar to multifamily, when you're scaling single family, there's a lot of efficiencies and economy of scale created the larger you get. We're very much a rental company as well. So we want to continue to lease and manage everything we own. It's certainly not a disposition strategy for us. However, we do occasionally sell properties. So our acquisitions channels, we're going to be acquiring properties on and off market, and we often buy through auction sites. We occasionally do direct to seller marketing. We have access to government service entities like HUD, access to REO product through banks and financial institutions. And then, like I said before, the first mortgages can lead to a rental property as well. So to give you an idea, some of the work, like this is a good example of what a distressed property will look like before when we purchase it. And then this is what a more of a value add property would look like. And then to give you some ideas of just our finished product. So to give you a little bit about our model, as we're looking at a couple picks from our portfolio, we typically want to be all into a property for $120,000. That could be a fully distressed property that we're buying for, anywhere between $15,000 to $30,000, and we're putting, $70,000 to $100,000 or so into it. Or it could be a value add property that we are purchasing for, say $80,000 and putting $20,000 to $40,000 into it. At the end of the day, we want to be all in at 120, and we want to see an after repair value on the low end of 165 to on the higher end of 190 plus. So we're typically going to be creating anywhere between 30 to 40% equity in each deal. And then what we'll do is we'll refinance, we'll do portfolio refis. So we're getting it's essentially all of our cash back and even more in some cases, and then redeploying that to grow our portfolio. So just a couple more pictures. I can give you an idea of the outside. So as I said, we are vertically integrated. We do all of our construction and property management in-house. This helps to keep our timeframes on budget, timeframes in line and then on budget. The property management is fueled by industry software, top leading software. So it's a streamlined process when we have maintenance issues and things like that. We also use our crews for any maintenance issues. And our team right now consists of 30 members between the management team, the accounting department, legal and compliance, and then the construction and property management teams. So to give you a little bit about our background, so management team has over 80 years of real estate experience. My partner, Ron, he's with us today. Ron, you can probably get into a little bit of your background.
Yeah, thank you, first of all, for having us. I've been in the real estate space for, it's more like 25 plus years now. Got involved in the construction industry in the late 90s, and eventually by 2000 had my own building and construction company. We also ventured into the investment space after about 5 or 6 years, and utilized that construction experience in the company and in our growth over the next 15 plus years. The foray into the space that we focus on now, which is really more the affordable housing space, which to me is probably the biggest housing issue in the country at the moment, was working with government services entities like HUD, the National Community Stabilization Trust, as a development services partner from 2015 on. We discovered a very strong need for, even before this uptick in the real estate market over the last few years, we saw a big need in the affordable housing space. And that's why we started focusing on the markets that we focus on. The reason we tend to stick to the geographic area that we do is in Baltimore, Maryland, New Jersey, and Pennsylvania, is we want to be able to look, feel, and touch everything. We, as Peter mentioned, we utilize our own construction crews and teams, from whether it be new construction to full rehabs, value add rehabs, and on the property management side as well. A lot of times we get the question, would you look outside the geographic regions you're focused on? And my answer is always, we're always watching other markets, but the demand in those 3 markets right now, we could buy 500 properties a year and we still wouldn't be satisfying the demand. So that's one of the big reasons we focus on the markets that we focus on. Peter can talk a little bit more about some of the other partners and their experience because they really round out our team.
Sure. And before I do that, you reminded me of one thing, Ron. So when we look at affordable housing, what that means to us is we want our tenants paying under 30% of their gross income to their monthly rent. So what that could be achieved through subsidies or not be subsidized. So what we'll say is about usually 60% to 70% of our portfolio is going to be subsidized through Section 8 vouchers. And nearly 90% or more of that rent is coming directly through the federal government. And then the other part of our portfolio is what we usually call workforce housing. So the tenants are making too much to qualify for subsidies, but they still need a rent that makes sense and that they can afford. All of our properties are going to be, oriented towards value generators like hospitals and other employment, other places where there's a lot of employment, and then there's transportation to get very easily to other places of employment. A lot of people in Baltimore will live there and work in Washington, D.C. because it's easy to get to one place to the other. So just to give you an idea of what we mean by affordable housing. So like Ron said, I'll round off the team here. So I come to GSP with 9 years of real estate and capital raising experience. I started my career working for a distressed mortgage company, so did a lot of first and second mortgages. And my chief responsibility now is working with our investors, making sure they understand our strategy, the opportunity, and just overall oversight of the construction and property management as well. My partner Wade. He 25 years of real estate, note investing, single family experience. At a time he had managed over 600 single family rentals. Now he primarily focuses on the note side of the business. So he runs that aspect of our company. Brian, he is our construction manager. He manages the crews. We have our Baltimore crews, Philadelphia crews. One thing that's good about the distances is we can bring guys either way depending on how we need them. And then John is our lead property manager, over 20 years of property management, real estate investing experience, pretty diverse too, in student housing and self-storage. He's responsible for making sure the tenants are having a really great experience and making sure that we're aggressively mitigating risk and taking care of issues as they pop up. So Bodie's our company mascot. People ask me all the time, what does GSP stand for? And it's German short hair pointer. So Ron's got two, Wade has had one, and he grew up with them. So these are very energetic, powerful, intelligent, very committed, enthusiastic dogs. So it was something that kind of fit our the way we look at real estate investing and acquisitions and construction and property management. So it was kind of a fitting name for us. So like I said, we raise capital through 506c funds. So they are only open to accredited investors, and we need representation on file. They're structured as LLCs, so the investor's liability is limited to their investment, and we accept personal entity, self-directed IRAs and solo 401ks, trust, all that kind of stuff. So right now we have two funds. One's our growth fund. That's more of a traditional profit and equity sharing fund. It's pays an annual preferred return. That's kind of like the foundational monthly payment. And then profit is split upon availability, semi-annual. And there's tax advantages in that fund. The income fund is a fixed rate, fixed term fund. So investors have they come in, they pick their term, whether it be 1 year, 3 years, or 5 years. There's going to be a fixed rate associated with that, and then it's monthly distributions or compounding. So they're the two funds that we're actively raising capital for. Like I said, we've had two other funds, GSP1 and GSP2. They're closed to new investors. Both of those funds have paid we're structured like our income fund now. Both of them have paid their fixed promise preferred return since inception. So I kind of saved the best for last. The investing in affordable housing, it doesn't just make a great return, and it's not just something that is repeatable in our markets and really all over the country, but it also creates a really positive impact in the lives of our tenants, the individuals, the families, the communities. It stimulates economic growth. It addresses housing inequality. It improves health and education and reduces homelessness. One thing that I go back to with what we really like about single family is, you look at the data, and 8 out of 10 people want to live in a single family home. So there's a lot of demand. A lot of times people, especially in Section 8 and affordable housing, when they get into a home that they like and, the experience is good, they want to stay there and they want to continue to call that place home. So that's my contact information. Like I said, we're based out of Philadelphia, always available for calls, emails, text, in-person meeting, that kind of thing. So, we're happy to answer any questions. And I think I set an alarm, so I'd be good on time
Oh,
there.
no, you're fine. You're fine. Thank you for that. Good stuff. Thank you as well for sharing the information. There is one question that popped up, but again, I'll remind people, please drop questions you have for either group into the Q&A. Looks like this one's up for you guys, though, related to the affordable housing.
Sure. So have we looked into mobile home parks? It seems like that would be a good fit for affordable housing. So it has not really been something that we look into. When it comes to what we do, we've kind of put the blinders on over the years, and we've really found a good model and, something that's really scalable and repeatable in the markets that we're in. And as I said before, there's massive benefits in the scale of a single family portfolio, especially when you do everything in house, from construction and property management like we do. There's benefits when the larger you are, and some key hires and things like that. So we tend to focus and see the demand more on the single family, 2 to 4 bedroom attached or detached homes. I don't know if Ron, if you have anything to answer to add to that.
No, I think you pretty much covered it. I mean, in the areas that we live in, it's not that mobile home parks aren't a good investment. But in our immediate region, the zoning for them can be an issue. So if there is availability of mobile home parks, the prices tend to acquire them are extremely high. So from our model, it doesn't really make sense. And it also doesn't really leverage our areas of expertise with the construction in particular. Because as Peter mentioned earlier, we truly like new construction or full renovations the most.
I'll throw one out to you guys while we're waiting for maybe some other questions to come in. Your model, like our limited partner community, our probably number one go-to asset class is multifamily. People are very familiar with how to vet it in our community and so forth. Can you speak to maybe how the limited partner investor would look at your deals differently, and elements they need to pay attention to understand what's good, what metrics make more sense in comparison to multifamily, knowing that they're different, they're going to operate different? Maybe you can speak to kind of what those differences are and tend to be that people ought to pay attention to.
You want to take that one, Ron? Or
Sure. I mean, I think, I like to look at real estate from a residential standpoint, whether it be multifamily or single family, in some respects in a similar way. And that's why whenever I refer to our portfolio, because we have, single family up to 4-unit buildings, our model revolves around a per door basis. So those metrics have been formed, they're historical numbers for us. They're not projections per se. We've looked at what we've done over the last 5 to 10 years. We've extracted that information. We certainly take appreciation, interest rates, and a number of other things into consideration when we're molding when we're working on our model or modifying it. So, the question that we get a lot of the time when people are vetting us is almost exclusively the question we get the most is the property management aspect of it, because there's this perception that managing multifamily is easier than managing single family. And I could say it is, and I could say it isn't at the same time. The way we're built and with our skill sets and what we've done for years, we're very comfortable managing scattered site single family. So I think it really boils down to the operator's area of expertise, you know, if it's the multifamily focus or if it's the single family focus. But I would say that's probably the number one question we get. You know, the other thing that we look at and that a lot of our investors look at as they come to understand it, our risk is really spread around. You know, it's not just in one single asset. It could be across 500 different assets. So that's another area where we see some differentiation.
So two things I would add to is the flexibility. So these don't have to be rentals. They could be a rental or they could be sold as a primary residence to someone. So the value of it as a primary residence, you know, usually in the first time home buyer market, since our values are typically going to be under 250 when you take into consideration like Philadelphia and parts of Jersey as well. So we really like the flexibility of, you know, being able to look at it in both ways as a rental and as a something that would be sold and, you know, sold to a first time home buyer. The other thing too is the financing is going to be different. So we have lines of credit, one with DLP and one with Lima One. So we can access, you know, upfront money on the construction side, but we will typically purchase and renovate in cash and then do a portfolio refinance. And that refi is typically going to be a 30-year fixed rate mortgage. So the financing and the structure is going to be a little bit different there as well.
Great. I was actually going to ask you about the financing side of things. Thanks for throwing that out.
That was a great
as
question.
well.
A question came through in the chat. UBIT blocker. I'm not 100% sure what the blocker part means, but I'm assuming when it comes to the funds, the income fund does not generate a UBIT. That's been our CPA's opinion for years. So I've been raising capital for fixed rate funds for a long time. I've never had an issue with UBIT come up in those types of funds. So they're perfect for an IRA. You know, it's not going to generate a UBIT. The growth fund, the profit and equity sharing, you know, and the leverage and you know, just the features of that fund typically would generate a UBIT. So yeah, maybe not the best for IRAs, but we have 2 CPAs in our funds now who are in the growth fund with their IRAs. They didn't feel like it was going to be significant enough. And I think depreciation too can be used to that. I'm certainly not a CPA or a tax expert. But typically for investors who are, you know, cautious about generating UBIT in their IRAs, they really like the income fund for us because it traditionally doesn't generate that.
Cool. Thank you for that. I would say, you know, Josh and Donato, if you want to come back on and we can, maybe Peter, if you could stop sharing.
Yeah.
If there are any questions for anybody left in the group, we do have a little bit of time left. Please feel free to drop them in the Q&A and ask your questions while we got them here live. By all means, their contact information has been shared for both groups. Please feel free to reach out with questions you want to ask directly to. But if there's anything to throw out to either group, we've got some time left. We can offer that up. And if it's quiet, then we'll call it and thank everybody for showing up today and everything else. But any other questions? Let's see how fast people can type. But well, with that, we won't keep you guys on just waiting around for it. By all means, thank you both teams for coming on and sharing the information today. We do appreciate that. We appreciate the support to the community. We'll get your contact information in the email that goes out with the recording as well. But thank you for coming on today and meeting the community. We appreciate it.
Thanks for having us.
Definitely. Thanks for having us, Jeb.
All right. Thank you. Have a good weekend.
You too.